Hi everyone, I'm your host, Adem Tumerkan from Speculators Anonymous. Today, I wanted to speak with you all about what I believe is the coming disinflation, meaning I think the inflation trade right now is extremely overcrowded. So I wanted to take some time, go over the history of inflation, my thesis on inflation, and what I think comes next with deflation. Also, at the end, I have a few great books I highly recommend about inflation, and I'll go over them, so stay tuned. So, let's begin with today. It seems like the mainstream financial analysts and experts are expecting waves of inflation. And they have a good point. The post-COVID world is full of supply bottlenecks, and also there's been years of low prices that have caused supply-side issues, especially in corn, China's hogs supply crisis after the African swine flu. There's been underinvestment in copper for years, etc. Same with nickel. And, the low prices created today's high price scenario. Now, that's all fine, and I'm not disagreeing. There is clearly above trend inflation, and I've been saying that for a while now. But what I believe the important question is this the beginning of an inflationary wave, like a new structural inflation, or will the structural deflation since the 1980s continue after 2021, meaning low growth, low rates, deflation to continue? Well, me personally, I believe in the latter, meaning I expect deflation to continue. And just to be clear, when I say deflation, I mean sub 2% inflation, which I'm 100% still against. As an Austrian, I hate any bit of inflation, especially monetary inflation. Because I expect lower inflation doesn't mean that it isn't continually eating away at purchasing power constantly. For instance, even 1% adds up, and 10 years later, that's a 10% decline in savings and purchasing power. So, before we get started, I think it's very important to go over the three forces of inflation. First, you got the demand side, also known as demand pull. Second, you got the supply side, also known as cost push. And third, you got monetary. That's the confidence of money, which greatly adds price volatility during cycles, amplifies inflation during booms and amplifies deflation during busts, etc. So, historically, dating back to about 1100 AD, most long-term inflation, and these were called price cycles, they would go between 50 to 125 years. Most of this inflation, known as creeping inflation, was due to the demand side, demand pull inflation. For example, during times of peace, people would marry at a younger age and have more kids, which would increase aggregate demand. If you have a certain amount of supply back then of apples, but then the amount of mouths to feed keeps rising, it will push the price of apples higher because, there's more demand for apples as there's more mouths to feed. And that demand side inflation was the one throughout history that would really cause restlessness, and it wouldn't be noticeable at first. But over time, as I said, it adds up, and people would start noticing later. It's like when you go to the grocery store. Most of us look at the groceries today, our cart, and we go, wow, I remember 10 years ago, I used to be able to get way more for my $100. See, that's the type of inflation I'm talking about. It's like you look back 10, 15 years later, and it's really noticeable, but it's not noticeable year to year. The second type of inflation, cost push, are more sudden. That was more volatile price spikes. That would most often be from a supply failure, like a crop failure, a war breaking out, a key commodity source like an oil well going offline. Like in the 1970s, the oil embargoes really pushed inflation higher. That's cost push. Cost push would be if the price of oil doubles, you go to get gas at the pump, and the price is going to be much higher there. The third form is monetary. And back in the old days, monetary usually was added from adding new sources of silver and gold. Making matters worse, pre-1970s, the experts didn't realize that monetary inflation was pro-cyclical, meaning that the more money they added into the system, the more inflation it created. So, for example, in the older periods, in the 1500s inflationary period, for example, they saw prices kept rising. So they said, hey, well, if prices keep rising, people need more money to afford these things. But this only aggravated things much worse. It wasn't until the 1700s that they realized that, monetary inflation had to act counter-cyclical. So if there's an inflationary period, you have to pull money out of the system. And that's kind of how we've gotten to, today's view on inflation since then. So let's take a very quick simplified and quick look at the last 400 years of inflation in just the US. And I'll mention some key points. So you could see that it wasn't uncommon all the way back, even in the late 1600s, 1700s, that you could see 20% inflation year over year. And then there would also be periods of 20% deflation. Then you would see, war break out, right in this Revolutionary War, you'd see prices spike 30% a year. So you could see that prices were very volatile, even in the old days. Even when there was no paper money and they used gold and silver, they were still inflation. From a crop failure happening, sending, grain prices through the roof, or a war breaking out and causing, the demand for goods to soar, etc. But after the Civil War, which caused a significant amount of inflation, you had what was known as the Great Deflation. And this was a period of between 1860 and 1896 when prices continually fell year over year. And it killed farmers, miners, debtors. They basically, this started pushing a lot of the U.S. Rural workers and miners into the populist groups that wanted to break from the gold standard, which Britain adopted in 1870, and all the other countries were following in, especially Britain's trade blocs like India, Australia, Canada, etc. And the farmers were getting killed by this deflation. But lucky for them, in the late 1800s, new sources of supply of gold were discovered in South Africa, which became the world's biggest gold-producing country, and Australia, which was right behind it. Then all of a sudden, you had more gold coming online, and since you're on a gold standard, that more gold in the system created some inflation. So then you had a little bit of inflation rising, keeping farmers, everybody happy. Then you have World War I breakout, which caused inflation to spike almost 20% for a couple years in a row, compounded. Then you have the Great Deflation after the war. All of a sudden you have all that excess demand. Then, it started picking up again in the late 20s. And then you have the Great Depression, which was multi-years of deflation, the worst period of deflation since the Great Deflation after the Civil War. Then you have World War II to pick up inflation again. You can get where I'm going with this. So the real thing we should look at now is what happened after World War II. Because as you can see on the chart, we have a big spike of inflation, and then all of a sudden, it's just a period of low inflation that we haven't really seen in any other period. It's not volatile inflation, it's just low, steady, declining inflation. Well, when you look at the Bretton Woods, which was the monetary system setup, it's not like, even though the dollar was pegged to gold, it didn't end inflation. For instance, the CPI between 1964 and 1971, while the dollar was still pegged to gold at 35 an ounce, the CPI rose over 50%. So prices were still rising even while we were pegged to gold. And the U.S. was exporting inflation abroad because they were pegged to the dollar, and the dollar was inflating, therefore that inflation was going everywhere, and they ended up breaking the system. Now, the big question I want to establish is a lot of people think breaking from gold caused inflation. But I think the break from gold was the symptom of the same disease, which was we had inflation occurring even while we were pegged to gold. And that was because we had excess demand, we had high supplies, we had high wages from aggressive unions, we had standardization in the US. It was like the death of creative destruction after World War II. Foreign competition got better, like the Germans and the Japanese took over the car industry, etc. And then after we broke from gold, new supplies came online, and the third industrial revolution started in the late 1970s. And the third industrial revolution is the age of globalization and technology. And that has been structurally deflationary, as you can see. Since the great stagflation period, it's just been low inflation. And the Fed has had to keep their foot on the gas trying to fight this. This is why the Fed has to continually ease, because they have to fight that structural deflation from the 1980s. But this is causing asset bubbles, inequality, and the deindustrialization of the US. Okay, and after 2008, things got even worse with deflation. So now that we took care of that, let's go to today. Well, my thesis is that even after this year's rising inflation from supply bottlenecks and the economy coming back online and a couple of years of supply destruction, we have a period now where what comes next? I think it's prudent, not prudent, I'm sorry. I think as a speculator, I like to focus on a contrarian perspective and a expected value perspective. Expected value means you're focusing on the magnitude over the frequency. So I care about the payoff more than the probability. So today, high inflation is already priced in. So if, like for instance, when that last week's CPI came in at 4.2%, it's like the highest in 30 years or something like that. The market, bonds, everything barely sold off because it was already pretty expected. But what if last month, instead of that inflation, that 4.2%, what if it was negative 1%? Now that would have been unlikely, hence why it wasn't priced in. But if that happened, you would have seen the markets completely reprice. So as a contrarian, I am looking at things as a skeptic and in expected value terms. Well, another reason I also think that we're overestimating the future inflation from here going forward, which is probably due to recency bias. A lot of people are seeing the high inflation recently, so they're thinking it's going to go on forever. Recency bias is a human cognitive flaw where we extrapolate the future today. So consumers since 2008 have had a horrible time expecting inflation. So as you can see in this chart, red line is the University of Michigan's inflation expectations, and the blue line is the actual CPI in all cities. You can see that consistently since 2008, the investors have expected higher inflation than there actually was. Another reason I think this is important is because history shows these manufacturing supply chain pressures will ease. So we see that these price bottlenecks happening on the supply side, these firms that are backed up and rising input prices, these will regulate themselves. The cure for high prices is high prices. Higher prices from supply bottlenecks in the manufacturing sector are typically short-lived, and these high prices and an improving COVID situation are going to bring on more capacity by the end of 2021. Now, mentioning capacity, that's also an important part to this, is because as you can see, the U.S. capacity utilization rate since the 1970s has been in decline. Right now, it's at a multi-decade low, meaning that there is a significant amount of excess capacity these manufacturers have if they want to ramp up online. So if high prices stay continued, you have a lot of US able to soak up a lot of this excess demand with instant supply coming online. And another big thing to remember is in the pre-1980s world, we were in a world of shortages back then. So you had capacity running, like as you could see in the 70s, it was running at almost 90%. So that pushed prices higher. But now we have a ton of excess slack in the manufacturing side. Another reason I think this deflationary pressures are going to start mounting in the future. Another thing I wanted to look at is the 12-month inflation if prices rise at 2%, meaning if the core PCE, the private consumption expenditure, rises, this is the Fed's favorite metric of inflation. If this rises at 2% each month, just for base effects, we're going to see declining disinflation by 2022. That's because the base effects in 2021 to 2020. Now, base effects is inflation. So you had, for example, we had such low inflation last year when COVID started that just coming back to normal inflation in 2021 on a year-over-year annualized change looks significantly higher. But so while it's going to make inflation from base effects look high throughout 2021 because 2020 was such poor inflation, that same situation is going to cause a deflation in 2022 because you're going to have mean reversion. You're going to have the high period of year-over-year inflation work against it, meaning if inflation just goes to 2%, stays at 2% from now all the way until April 2022, after it spikes up, you're going to see a decline again. So these are reasons, mentioning base effects, why I believe prices, especially the CPI, are going to revert. This chart from Guggenheim, if you look at the assumptions of a 0.3 month between April and June, you're going to see that the core PCE, after spiking throughout 2021, adjusting for last year's disinflation from COVID, deflation is going to begin continuing again, which makes sense. You have such high inflation this year that the same amount next year is going to look lower just because of base effects. So people are focusing too much on the headlines without accounting for the 2-year price changes. And when we look at the 2-year price changes, we can still see inflation still well below 2019 levels. So what does this all mean? In my opinion, I think the market where investors shouldn't be in the inflation overcrowded trade. While I do expect there to still be inflation, because as I said earlier, the Fed has to keep their foot on the gas. They can't back out at this point. They're fighting structural deflation. The market from the Industrial Revolution and technology is pushing deflation, but the Fed can't have deflation because we're a world of debtors. So you have the Central Bank of Japan, the Central Bank of Europe. Every central bank is going to have to keep easing as they fight deflationary private market forces. A few books I recommend before I close out of this, I think are very well worth reading is, first, you have The Great Wave, The Price Revolutions and the Rhythm of History by David Hackett Fisher. This is one of the most important books I ever read on inflation. It goes back all the way to 1100 AD, and it shows the 4 major price cycles. This is where a lot of my thesis comes from, showing inflation through crop failures would, creep up, through more mouths feeding in times of peace. You would have creeping inflation of 1-2% a year. Then all of a sudden there would be a crop failure suddenly, etc. People would start pricing in the inflation after 50 years. They started really noticing it, and it would cause all sorts of chaos and rebellions, and empires would crash. It's a great book. I highly recommend it. Second is The Monetary Regimes and Inflation, History, Economic, and Political Relationships by Peter Bernholz. To me, this is one of the best books you can get on monetary inflation. It shows the government side of inflation and how regimes in the past have tried inflating their way out of debts and how it's ended terribly. It talks about the different types of inflation, from creeping to steady to hyperinflation. That's a must-read book. Third is The Rise and Fall of American Growth by Robert J. Gordon. That book is very important to show the structural deflation from the first, second, and third industrial revolutions. Starting in the late 1700s, when you had the cotton gin, the telegram, the steam engine, all created in the first industrial revolution, how much utility it brought and how much aggregate demand it brought online from people building these things. But the thing is that it came with a lag effect. R.J. Gordon's thesis, though, is that in the third industrial revolution, which started in the late 1960s, the computer, known as the infotech and computer age, there hasn't been crystallized gains for workers, meaning the marginal utility for workers now is in decline compared to the first 2 industrial revolutions, which is why inequality is getting worse. Another reason the Fed has to continue easing is that they had to bring easier debt financialization into the economy to supplement diminishing incomes. I think his book is brilliant and very well relevant to the inflation story today. The fourth book is Global Capitalism, Its Fall and Rise in the 20th Century and Its Stumbles in the 21st. Basically, the age of globalization and tech are net deflationary because you can import deflation, you can import excess production from abroad. And when you have excess production globally, like China and Germany and Norway, these surplus nations, that means they're they're producing more than they're consuming, which is increasing supply more than demand. His book is brilliant and shows all the way back from the early 1800s and the different waves of globalization to protectionism, and it shows how prices moved in those cycles, which is why today it's important seeing how we're in an age of globalization right now, how it's deflationary. And unless big protectionism rises out, that'll probably continue. And then the fifth book is The Technology Trap: Capital, Labor, and the Power in the Age of Automation by Carl Frey. I think this is a brilliant book because it really shows how deflationary technology is, and how after the 1970s, the net marginal utility per worker really began declining compared to the first two industrial revolutions. A lot of people don't realize, like, for instance, when they created electricity in the first industrial revolution, you had to go rewire homes. You had to get all that copper to put, electricity from steam in all these homes, in all these factories. That's a lot of copper. That was a lot of workers. When they built the highways out, all that cement, when Eisenhower, did the Freeway Act, the National Highway Act, you had to build all that cement, get all that cement, all those resources, all that labor. That's a lot of demand, aggregate demand. But the third industrial revolution, we've seen automation start replacing the workers and all those commodities. So that book is very important in showing that how to put it in summary, the third industrial revolution wasn't a revolution, it was an evolution. For example, getting that first iPhone was a huge game changer. But now getting the iPhone 6 is just, a smaller, sleeker, more efficient version of the iPhone 1. But it's not nearly as important as the first telephone was back in the early 1900s, utility-wise. Same with a car. The first car created in the early 1900s expanded productivity, significantly. But now getting a 2018 Nissan versus a 2021 Nissan doesn't increase productivity the same way. So yeah, I recommend reading these 5 books. They greatly influenced my way of thinking. And just in summary, I think that deflationary forces in the age of globalization and tech are going to be a lot harder to get rid of besides just a post-COVID economy rebound. I think the Fed and global central banks are stuck with their foot on the gas because they can't risk letting up, because we're a global economy full of debt that if interest rates even rise remotely or suddenly, it could create great negative tail risks for the economy. Those black swans lurking at every corner, and the more money there is in the system, the more volatility there is. Thank you for paying attention. I didn't mean to go off topic so much, but I hope you took something beneficial away from this talk. As always, none of us know what will happen in the future. I could be wrong. But as always, I focus on the expected value, meaning I go for where the magnitude is, not the frequency, because anything can happen. I just want to make sure if I'm wrong, my losses are limited, and if I'm right, my gains can run. Well, anyways, thanks to Jason for allowing me on today, and everybody else, have a great day.
I hope you liked this video from Adem, or at least thought it was thought-provoking. I've known Adem for a long time now. He's a very good analyst. He's a contrarian, so he tends to think differently than a lot of the mainstream analysts out there. So when everyone is overcrowded on one trade, Adem is normally looking for options plays on the other. And to add to his arguments here, commodity prices, especially commodity prices like lumber and others, are starting to crash. They're back down to around what they were 3 months ago, according to a recent tweet out in the last few hours from hedge fund manager Tavi Costa. So some industrial commodities are down to 3-month lows after going up almost parabolic. And one of the major reasons, as you can see there with the charts on your screen, the left-hand chart, is the amount of credit that the Chinese government is pulling out of their economy. So that red circle there, they're pulling out an enormous amount of credit inside the Chinese economy, and also policy decisions inside China. There's been a number of stories out in the last month or so, and I'll put links to them in the information and description section for the articles if you want to read more about this. But the Chinese government over the last month or so is trying to impose more draconian commodity price controls inside China's domestic economy. So they're trying to stop speculation. They're trying to, in my opinion, cool off commodities prices inside the Chinese economy for at least a couple months, take a little break. But overall, the majority of China's trade surplus dollars are still being reinvested into commodities, but a lot of those commodity prices have gone up, in the Chinese government's opinion, too quickly. So those are commodities like copper and lumber and industrial commodities. So some of those commodities may continue to correct, or at least take a break from going up for a little while. And that seems to be a policy decision by the Chinese government and the Chinese banking system. So if you liked this short little video that Adem put together, and I know he spent a lot of time on it because he was not familiar making these types of videos, so it took him a lot of time to figure out the software and how to do it. Maybe I will have him periodically make videos like this for my YouTube channel as guest posts. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, please consider becoming a patron. It is only $5 a month, and there is almost 170 articles, charts, and audio podcasts behind the paywall, including 11 new articles out in the last 5 weeks and a 45-minute interview with Sandstorm Gold CEO Nolan Watson, exclusively just for patrons. There is a lot of in-depth research, analysis, and financial education and analysis on specific companies and sectors behind the paywall, including a new royalty and streaming company that is cash flowing similar amounts to Sandstorm Gold that just IPO'd in the last few weeks.